what a lot of professional traders do, and what I do, is if I'm buying high, I'm hoping the market goes up higher and I can exit with a profit. But I will use a very wide stop, and really importantly, I'm willing to add on. So I'm betting on two things if the market is strongly bullish. It's either going to go up and continue to be strongly bullish, or it'll transition into a trading range, not become a bear trend. Strong bull trends typically either continue or they convert into a trading range for a period of time before they become bear trends. And if it enters a trading ranges have legs that go up and go down. If I buy at the high and then it starts to convert into a trading range, it goes down, I buy more, and I expect it to go back up to the top and start to look like a trading range. So if I buy, let's say I buy at 100 and then it falls to 90 and it starts to go up again, I'll buy more at 90. If it gets back to 100, now I'm thinking, well, maybe it's a trading range and not a bull trend. And if it's a trading range, so I want to be long at the top of a trading range. So what I'll tend to do is I'll tend to exit. Remember, I bought at 100 and I bought at 90. When it gets back to near 100, I'll get out at 100, break even on my first buy, and with a profit on my lower buy. And that sounds simple, but the single biggest reason why traders lose money trying that strategy is they trade too big. When they buy their initial position at 100 and they see the stop has to be at 90, they're comfortable risking that amount. And they think in their head, I'm okay, I'll buy more if it gets down at 90. And what most beginners do is when it gets down at 90, they say, oh my God, I'm down 10%, I better get out. And that's the exact opposite of what they should be doing. They should be looking for an opportunity to buy, again, to double the size of the position. So, but as I said, this sounds easy, but it's very difficult for beginners to do. Beginners are much better off getting out early and not holding through the transition into a trading range and then scaling in. But that is, I do that. I do that all the time, and it's a very good strategy. If you do it and you do it well, I think you have an 80% chance of not losing money. So if you buy at 100 and it falls to 90, two things can happen. Keep going down. I'm not going to buy more unless it looks like it's starting to turn back up. And if I buy as it's starting to turn back up, I'm expecting one of two things to happen. If the sell-off is not too strong and the reversal up is reasonably good, I'm going to hold for it to get back to 100, and then I'll get out of the entire position at 100 with a profit on the lower and break even on the higher.